Class is now starting. All attendees are in listen-only mode.
Good morning, everyone. We'll give everybody just a few more minutes to come over from the hold screen into the webinar, and then we'll get kicked off here in a second. You can see the attendees are still climbing, and on the screen you'll see we'll start the presentation at 11:02. I've got 11 on the dot. We'll get kicked off here momentarily. All right, folks. Good morning. My name is Justin Caron. I'm the VP of Member Services here with Metrostudy and Meyers Research. Welcome to the MBIA market update, specifically around COVID-19. As you can see on your screen, Mr. Ben Sage has joined us, Regional Director of Meyers Research and Metrostudy, familiar face. Today's presentation, I want to say about 45 minutes. We'll save 15 minutes or so towards the end for a Q&A. Your lines are muted, so you can't chime in with questions. However, if you do have a question in the presentation, you'll see the chat function on the right-hand side of the control panel there. You can submit questions, and if you'd like to ask the question during the presentation, just let me know. Hey, can you pause Ben and let me ask really quick? We can unmute your line, or I'll read the question for you. We'll save the majority of those questions towards the end of that presentation and run a Q&A directly with Ben to get those answered. We are recording today, so we'll save that recording and we'll send that link on over to MBIA for sharing with the membership. With that, go ahead.
Thank you, Justin. In my mind, Metrostudy is known for customer service, customer engagement, and Justin is the architect behind that nationally for all of our clients. So if you've ever been a beneficiary of Metrostudy's exemplary customer service, you can either directly or indirectly thank Justin, who also has quite a bit of experience hosting webinars for us on a national basis. Just if you're not sure who Metrostudy is, Metrostudy, Meyers Research is one company, along with builderonline.com and other publications. We provide housing market research and related and other services to home building and the related industry, market studies. You can see advisors or market study consultants, 60 of them, 500 researchers, 50 technologists. We're working hard right now to integrate both the Metrostudy and Meyers or Zonda databases. So basically, if you have a question involves research, give us a call. We are also, I guess you could say, a satellite company. We've acquired Bird Eye just recently, and this will give our clients and anybody who needs satellite imagery updated hyper frequently. This is going to be a new service that we provide So look for more details about that. We're going to start, we have a couple of polls, but we want to do kind of a warm-up poll, Justin, if you don't mind launching this. So this is an audience participation, if you could be ready.
Poll is open. We are collecting responses. We'll give it about, say, 10, 15 seconds. We've got about half, 60% has now voted. At 75, we'll bring it home. There we are.
Okay.
There are your results.
Very good. What I would have expected, I think. And wherever you are, I hope you're comfortable. And I think we are good to go for our next poll when we get there. We're going to start with the national overview. And I'll give you a reminder about this later, but our chief economist, Allie Wolf, and in the last couple of weeks, she's been joined by senior managing principal, Tim Sullivan, has been providing every Wednesday afternoon, 2 o'clock Eastern time, a national overview, and I've gotten great feedback from clients and non-clients alike. This is a free service, so you'll see at the end where you can find that. So I'm pulling some of that from her presentation. So this is look at the Great Recession and its monthly job growth, or losses in this case, and the months preceding and then into the Great Recession. And you can see 10 months in, we got to the point where we were losing 700,000 jobs per month. This is this year through March. This was released a week or week and a half ago, and you can see how quickly we slammed on the brakes with this economy. With it, the first month of the recession, basically losing 700,000 jobs. So this is unprecedented, really. And if we look at the makeup of those jobs, I mean, you've probably read the headlines. I mean, it's affected a majority of the major industries, but clearly an outsized effect on leisure and hospitality. You can see construction has taken a hit, but that's been mostly in the non-residential sector, whereas actually residential construction hiring is up, at least through March. This is available nationally only. It usually will be towards the later part of the month. I'd say in the next week or so, we'll get the results on a local level and regarding metro areas or states, but nothing on that as of yet. But it's communicating at least this first look, and this is a preliminary number, but it's communicating what we all know, and that is this is hitting hard and fast. Now, leisure and hospitality, there's a glass half full, glass half empty way to look at this. In some ways, this is the most vulnerable of our households with on average the lowest annual income in that sector. But the glass half full, so this is really hard hit, and no doubt every one of us knows somebody who's been affected by either a job loss, a layoff, or furlough in this arena. From a pure home building standpoint, this is not the type of income that would typically be able to afford a home in this area. And so, it's so far hitting the group that's least impacted by home builder buyers, I would say. Generally speaking, though, you can't rule out the possibility that in many cases, this could be a supplementary income helping a buyer get into a home in this area. So that's the leisure and hospitality. So what has been the results of this, or what has been the response? And so the Federal Reserve pretty quickly, I think they had a couple of emergency meetings before their regularly scheduled meetings. They understood the emergency here. They dropped the federal funds rate to near zero. They've started purchasing securities. At first, they put a kind of a dollar amount on it, and now they've said that it's kind of unlimited and not necessarily timed. There's as needed. Basically, they'll be purchasing securities. They're not calling it quantitative easing this time around, but it's basically the same strategy. And then they've also announced, this was last week, mid to late last week, $2.3 trillion in loans. When the Federal Reserve is a lender, and they're known as the lender of last resort. So they don't give away money, but they do provide some regulatory, some purchasing of securities, as you can see. They operate, and 2.3 trillion, could potentially go a long way. 600 billion in loans made to Main Street, well, I'll come back to that, but they're really trying to help regular businesses and not just the big businesses. So the Fed moves have actually in some ways helped mortgage rates. If you look just a few weeks ago, that 3.25-26% mortgage rate, that's the lowest all time. We've never had mortgage rates, according to Freddie Mac's survey, be that low. And then it was volatile. They shot up and then have come back down. Your local mortgage professional knows a lot more about this than I do, but there has been some uncertainty in the mortgage arena. And it has to do with the forbearance. And any homeowners out there with an agency loan pretty much cannot be foreclosed on if they've been impacted by the coronavirus. And I can better word that. You don't have to even prove that you've been affected by the coronavirus. You just have to state that you've been affected by the coronavirus, and you can start skipping payments. You'll have to pay them eventually, and I think the interest might also accrue. But it's not a high bar to get that, or at least try to get that forbearance from your bank. And so this has created kind of a moral hazard. And so now, most mortgages get resold into the secondary mortgage market. In fact, one thing the Federal Reserve does is buys mortgage-backed securities. And with that forbearance comes a higher risk, because the mortgage servicing companies are still on the hook to pay the investors the principal and interest on every loan. So even if the borrower, the homeowner, stops paying, the servicer is typically still going to be on the hook. So there's a lot of industry professionals looking to FHFA to direct Fannie and Freddie to backstop these. That hasn't happened yet, but there is some optimism that it will. But anyway, that uncertainty as to whether, how easy it will be to sell that mortgage into the secondary market has raised the bar for lending standards. So required FICO scores are higher. The jumbo loan market, which is important in this high-priced area, has, I would say, virtually shut down. So big changes there. There are still avenues to get funding, but it's much changed, and so we're looking for, and hopefully we'll get a little more certainty to replace with the uncertainty that's out there on the mortgage side right now. When I did a roundtable of builders with a virtual conference call a week ago, almost everybody led off. Every home builder leader led off with the trouble they're experiencing with the new mortgage qualifying standards. This is the federal government response to the crisis. So that was the Federal Reserve Bank. This would be which is monetary policy. This is going to be the federal government's response or fiscal policy. And NPR put this together. So, I see $2 trillion is probably a rounded number. I think it was 2.14, 2.15. I've seen 2.2 trillion, whatever the number is. We're only talking a few $billion in difference there. But you can see 560 billion of that going to individuals. That's going to be with the stimulus checks that get mailed out. I think they're already starting to be mailed out. It does, if everybody's expecting one, it does phase out over $200,000 for a couple married filing jointly. So that's part of it. And then you can see the other benefits. I blanked on the other aspect of the individual benefits. The other would be extended unemployment benefits, and we'll talk about that more in a minute. So a lot of money being thrown at this. I'm reminded of that line from the movie Contact about the government policy being why build one when you can build two for twice the price. Contact was an alien movie a long time ago. But anyway, this is starting to throw money at the problem, and here's 2 trillion of it on the way. The small business circle there, $377 billion. This is funded by the SBA and it's administered by banks. Loans for small businesses, you take 2.5 times your monthly payroll, excluding higher income employees, with a max loan of 10 million. There was a report yesterday from the Baltimore Business Journal that 12,000 of these loans have been approved in Maryland, an average of $300,000 per loan, total of $3.76 billion, I think, have been approved. As of last week, no funding had gone out. I don't know if the funding has shown up yet or not. So I call these loans, and you see that first bullet point, I put that in quotes. So, if 75% of that money is used for payroll, and the employee headcount does not decline, and salary and wages are not cut, then this loan becomes a gift. It is totally forgiving. So this is a huge benefit. And I have had several, and this came out last week with the MBIA webinar with OFID advisors, that some on Friday, I think it was, that we have seen some approvals even among home builders, and this would be home builders that meet the criteria above. So moving to the consumer sentiment, you can see a big decline here. I usually use the conference board. This is the one from the University of Michigan, has come out a little bit earlier and showing the decline that we expect to see. And starting to look at housing, Metrostudy, Meyers Research is a partner with BDX, who is a consortium of builders that provide a web portal for their communities. And so this is traffic, and so we had a notion at Metrostudy that when the foot traffic started to decline, that online traffic would increase, but there was just too many distractions. So the initial reaction among consumers was less traffic of both types. Foot traffic and online traffic fell, and then lately you can see that the online traffic in blue this year is catching up with where we were a year ago. So while we're down from a year ago, it is catching up, and we are up on a week-over-week basis. So Metrostudy has been polling home building leaders. These are CEOs or division presidents only. And this is the national survey as of this week. So this is a Monday survey that went out, just less than 350 responses. And as far as how are they responding, 90 responding to the crisis. And week over week, 97% of builders kept base prices flat, but 30% increased incentives week over week. I can tell you I got a peek at our local survey, because I send this out to all my home builder leader clients in the Mid-Atlantic. 100% of builders reported that they kept prices flat week over week, and only 15% of builders, at least for this past week, reported an increase in incentives. And then 31% of builders report increased cancellation. That's no surprise there. It's a similar number for this area, but I'm going to talk more about that a little bit later. We also asked home builder leaders nationally, what is your current plan for housing starts compared to your original 2020 plan? And here 46% say slightly decreased, and then on top of that, some say a significant decrease. I can tell you locally, this was, again, I peeked at this week's, and we're doing better locally than other areas of the country in general in the Mid-Atlantic. So locally, 40% of builders say they have no change to the original 2020 plan, whereas 60% would say an increase, either slight or significant. What actions are you taking with respect to land? How is your land strategy changing, basically? And you can see here, moving forward or being more cautious or more selective versus pausing or canceling altogether. Now, this is nationally. In a land-constrained market, you would expect this to favor the left side of the graph, where you're moving forward, or at least moving so selectively. This is a land-constrained market, as is Utah. I heard from my Salt Lake counterpart yesterday. We're both reporting, and builders are telling us that we would have a much larger percentage that are moving forward with planned or taking a pause, and far fewer moving forward or moving forward selectively, with a smaller percentage taking a pause. There's a hunger for land and a lack of it, so it's not like everybody's trying to shed too much land all of a sudden. Certainly not this soon into a shock like we've experienced. So let's go to our next poll, Justin, if you don't mind.
Poll is open. It's what type of national economic recovery do you expect?
Thank you. So, the V-shaped would be a quick recovery, a U-shaped, and if you want more insight into maybe the historical types of recoveries, if you go to metrostudy.com and look for Metrostudy TV under, I think it's news and analysis, then you can look at Ali Wolf's, our chief economist, her very first kind of COVID-19 webinar. I think it was the first one. Detailed, the different types of recoveries. And so here, I'm surprised. I would have thought we'd have a higher percentage expect a V-shaped recovery, though I can't say I disagree with the medium U-shaped recovery. If it had been me, I would have wanted a more detailed, because I'm I'm an analyst. I would have wanted a more detailed option, something between a quick recovery and a medium recovery. That's what I would tend to think. I do think this will be a quicker than normal recovery, but I don't think it's going to be a snap back like some people might. We can always hope for that. I don't think it'll necessarily happen. And one thing to keep in mind is what happened to this area after sequestration. And that was a kind of an isolated event. It was a national event, obviously, but it was outsized impact on the Mid-Atlantic economy, particularly DC Metro related. And I was amazed at how long it took housing to bounce back from that. And so that's just something to keep in mind. But, time will tell. And if you keep tuning into Ali Wolf's webinars, then, I think we'll even get more informed about where this is going. So let's look at some local economic indicators. So this is initial unemployment claim. I shouldn't laugh. I mean, it's just so, comparing the Great Recession, where, the worst month was just over 12,000 initial claims for unemployment in Maryland. You can see, over 100,000 in the most recent week. And so really, this is just so bad. It's not even comparable to previous recessions, not even to the Great Recession. So this is why we would hope for a bounce back. Let's look at unemployment benefits, because that's one of the phase 3 rescue plan benefits. So the standard unemployment insurance benefits is for a period of up to 26 weeks. An average amount nationally is $464, and that just varies depending on the state. These are managed by the states. It is funded by state and federal taxes and by private companies paying unemployment insurance premiums. So it does vary by state because it's managed by each state. In Maryland, it's $430 per week. And some states will add for dependents. I don't believe Maryland does that. So the added benefit from the CARES Act is an additional $600 per week on top of the state benefits. And instead of 6 months, it extends an additional 13 weeks or additional 3 months, so up to 9 months of benefits. And I believe they're both extendable. So this could be $1,000 a week, roughly. And I think it does end by the end of the year. So I think anybody signing up here, it's mid-April, I don't think would get a full 9 months. And this is if you're laid off or furloughed. But you would get through the end of the year. So that's, for those, if you annualize it, it gets to roughly a $50,000 a year benefits package. When I put these numbers together, it was almost shocking how generous this is. And I get it. And you look at who's been hurt the worst by this. And nobody's going to get that much. I'm annualizing it, but it's over 9 months at the most. But still, it made me wonder if the benefits are so generous that it might be almost encouraging some employers to lay off their employees so they can benefit. I do know this has happened. How widespread it is not known. So how does Maryland compare to other states in terms of the percentage of the labor force that has filed for unemployment insurance? It's really, it's been a 3-week, it's really been, the past 3 weeks have been the hardest. This is released every Thursday. And so this is through last Thursday's report, which I think goes through, the previous weekend. And so fortunate, Maryland and Virginia are both in the top third of states as far as least impacted so far. Doesn't mean it's not a major impact. I don't mean to belittle that at all. It's been a huge impact on our local economy. You might have seen that Marriott furloughed, 2/3 of their 4,000 employees at their Bethesda headquarters. And so, I mean, this is obviously, real. But relatively speaking, well, we're not South Dakota or West Virginia. Maryland and Virginia are doing better than most states. If we look at the states that have been hardest hit by unemployment insurance claims, I've circled. You see, DC there would be among the top third, but just barely there. But our neighbor to the north, Pennsylvania, and I highlight Michigan as well, being the hardest hit with over 16% of their labor force filing for unemployment here in just 3 weeks. And so it reminded me of this graph. You can get this at builderonline.com. And there's as many websites do these days. You'll see a COVID-19, hot link. And you can pull this up and you can see there's one for construction, another tab for suppliers. But, if you're wondering why Pennsylvania and Michigan have been hit so hard, I mean, they shut down home building industry would be at least one explanation. Now you see Washington did so as well, as has New York. Those came later. They remained open for a while until a shutdown order of all industries eventually came. I also wanted to mention, while if I clicked on the suppliers tab there on the map, then you would see Pennsylvania in green. But what that would not show is that that's suppliers. Manufacturers have been shut down and are shut down in Pennsylvania. And here I'm showing a cabinet company district or warehouse, and they have shut down. Cabinetry is a big part of the Pennsylvania economy, or at least among home building supplies. Cabinetry is a hub. My Denver counterpart got a letter from one of his cabinet suppliers saying that they get it out of Pennsylvania, that's shut down, and look for a delay. So I have my builders are certainly impacted by this, my builder clients, and they are scrambling to find alternative cabinet suppliers so they can proceed with closing. So this keeps coming up, and so I'm not given much optimism that this will be resolved before the general crisis is resolved. So this is one way that builders are having to reapproach issues or approach issues that come up. Now also, I think 30% of home building supplies come from China, and so there was some interruption there as well. But builders are having to manage this crisis, as you can see. So looking ahead, as far as unemployment insurance, which states have the least exposure to these high-risk industries? And them, we showed them earlier, leisure and hospitality especially. And you can see, well, we're not the most insulated. We are fairly insulated in the top in the top tier. I think that's going to be the top 30% of states with some protection where we're not as dependent on the leisure and hospitality. Florida comes to mind as one of the bigger states. They've not been hit as hard yet by layoffs, but if this extends, then there is a lot of service industry, hospitality jobs in Florida comes to mind as an at-risk state. So let's look at the housing market in Maryland.
Hey, Ben.
Yes, sir.
Quick question on the unemployment before you move on. In your research, were you able to find anything that addressed directly part-time employees and their eligibility for unemployment pay?
I did look at that, and in some cases they can be, but I don't know enough to fully answer that question. I do know that part of the phase 1, 2, and 3 of the coronavirus rescue plan is it did allow for unemployment insurance from the gig economy workers. So your neighborhood Uber driver could potentially file for unemployment. So if that partially answers the question, then yes, there is some increased benefit from the rescue plans that allows for at least that type of wage earner to get unemployment benefits.
Thank you.
All right, so here is some housing indicators. March resale listings compared to 1 year ago. And I pulled this up. This was from Realtor.com because I don't have access to the local MLS. I'm not an agent, and so I'm dependent on the reports from Bright MLS. I should have sourced Realtor.com here, excuse me. But I'd also pull from Bright MLS every month, but those don't come out till mid-month. And so this was my first hint at what's going on with listings. I thought, yes, I'm not surprised. Home sellers, don't want people marching through their homes that might be carrying the virus. And so here you can see in Baltimore and DC, low 20% decline in listings from a year ago. And then yesterday or the day before, Bright MLS came out with their monthly updates. I keep track of it by county. Here I'm just summarizing, most of Maryland. I think it excludes some of the Eastern Shore counties, but this would be the year-over-year percent change in listings. And so there's that March at the very right side of the graph, minus 22 or 23% there. But But you see in February, pre-coronavirus, we were already down almost 20%. And so I do think this did exacerbate it. But remember, this is as of the end of March. At the time, that was only 2 weeks into this, roughly. Well, I guess in early March is when we started hearing about it. But then in mid-March is when the unemployment insurance started pouring in. We were going to be down anyway. So I'm not sure. There's probably some realtors on the line that might know. But my sense is that, yes, some people have taken their homes off the market, resulting in a decline in listings as of the end of March, at least. But that there's probably a lot of homes that shut down showings and yet may not have taken their home off the market officially. And so that's why I was kind of looking for a larger or a decline in listings here. And I think that may come depending on how long this lasts and depending on how the home seller and their realtor handles this. Do they just totally take it off the MLS, or do they just pause showings and leave it on there for marketing purposes? I don't have as much insight to that, and feel free to email me or call me offline if you want to share that insight. I would appreciate it. Let's talk about where we are now versus where we were then heading into the Great Recession. And so, my typical Metrostudy presentation is, looking at our quarterly field survey results. We send field researchers out to every new home subdivision. They drive through the lots, through the community, and mark the status of each lot on a lot-by-lot basis. It's very tedious, but it yields amazing supply results. Demand results are a little bit easier to get on the home building side, either through closings or starts or sales. But the supply side, how much housing inventory is out there, how many lots are on the ground, the futures tracking. We're tracking all the deals that are going through entitlement. We do a lot of research. We're a research company. And so I'm usually talking a lot about that and then supplementing that with the latest results from our Meyers survey of home builder sales offices, equally rich in information and more timely because that's every month compared to our quarterly. So I look at both. And so here we did our field survey in the second half of March. And obviously, the change in starts are not going to be reflected because the coronavirus hit in the second half, most heavily, at least in the second half of March. And so I'm loving having the Meyers information available. And also we do a weekly survey of builders. And I'm not talking about the survey of home builder leaders. I'm talking builders send us, a select group do. It's open, but about 40 to 50% of the industry is reflected in our weekly survey of builders who send us traffic contracts and cancellations. So I just said, is there any value to this field survey information, which you're looking at right now? The gray column is vacant developed lots on the ground. And this is the peak of the market. I'm trying to get my slides to advance, if you'll excuse me. And so that is when the market peaked. as far as demand goes. It was mid 2007, and that's when, you know, everything hit the fan, as they say, and builders backed way off of starts and started scrambling to get rid of their inventory that was in process. So this is land inventory, and you can see we were growing. There were 13,000 finished lots on the ground, but we were in a growing posture, and we peaked at 16,000 just because there's too much momentum just to stop development, even though it was clear we were heading into a housing slowdown, though the depth of that was not clear at the time. So let's look at now. So heading into this current recession, you know, we have far fewer lots on the ground, and we were not even able to increase the amount of lots on the ground, even though we've been in granted an expanding market, granted a slowly expanding market. So we're in a far different footing now than we were then as far as land goes. We're a very land constrained market, and that's why the builders locally are responding differently to builders nationally who might be getting much more cautious on land. Builders here getting slightly more cautious on land, I would say. So let's look at new home inventory. And so to our field survey, a new home inventory unit is just one that is on the ground and shows no evidence of occupancy. So this is under construction, which is the majority of this, or it's finished and empty units. There's always some of that as far as, you know, between finishing the house and having somebody actually move in, because we're looking for evidence of occupancy. And we also will supplement our observed closings data with deed closings data. And of course, builders report to the Meyers Research methodology how much spec inventory they have, which helps highlight, well, it helps supplement the information we have from the ground. And so heading into the Great Recession, there were 7,140 units either under construction or finished and empty then. So that was what was in process, and you can see it was about 8 months of supply. And now heading into this one, you know, we're down to just a little over 5,000 units in process. So about 2,000 fewer units that basically you call that exposure or risk. And we'll look here in a moment at the cancellation trends for builders as far as what they are reporting. So again, we're in a much better position heading into this recession than we were heading into the Great Recession. The Great Recession was led by finance and housing. This recession is an exogenous shock, as they say, and home building is being dragged down with it, but is in a much better position to weather this. And I believe we're not going to see near the change in pricing or other things that went along with the Great Recession housing crisis. So here is the Meyers Research or Zonda survey of all communities and the results through March. March is preliminary. That's why we do it on a per subdivision basis, because it won't be till probably another week and a half that we get kind of a finalized number for March. But you can see on the left side of the screen, the light blue is year to date. So we were ahead of last year. And then by the end of March, we're now behind where we were last year. So this is comprehensive survey of all the active new home subdivisions out there. Now, so this includes big and small, and builders, that is, and it weights them equally, which is appropriate. If we compare the decline in March to a year ago, this is several metro areas across the country. Do remember that February was a very strong month. Builders were doing very good in the first couple of months of this year before the health crisis struck, not only locally, but nationally. One of my builder clients described housing as a bullet train earlier in the year, and now having to kind of hit the brakes with all this what's happening. So February was very strong, and you can see, even though we're down over 30% in DC Metro, I apologize that Baltimore, I didn't have that number here. I stole this from Ali Wolf, her presentation last week, so hopefully get an update, and we'll get Baltimore on this next time. But that is still better than most of the major metropolitan areas around the country. That's one reason I say we are weathering this better, and you got to admit that DC Metro, Baltimore, we do have a reputation for handling recessions better because of our employment base. Now, Metrostudy, I mentioned earlier, does a weekly survey of builders. This will skew towards larger builders, and so this is why you'll see some higher paced sales rates here compared to, our comprehensive survey. You might have a small builder that's happy to do one a month. Whereas here, the big builders, are more volume based. This is not all big builders, but it is skewed towards larger builders. And so you can see that we actually were experiencing, and even, among the bigger builders, a much better start to the year than shows with our comprehensive survey of all builders. Approaching for an average of 4 sales per month. And you can see this is starting to come down. I don't have last week's results, so this is as of a week ago Sunday. So that strength earlier in the year was propelling builders in the first quarter, at least, to aggressively raise prices. So they did not raise prices. Look at the 1Q20 column there. This is looking at a floor plan to floor plan comparison. They did not raise prices 4% in the first quarter. You can divide that by 4. We annualize each of these columns to give a sense of builders. And so that 4% is not an unreasonable price escalation, and though it is the best we've seen in a couple of years. So builders were definitely experiencing this, and really we're so constrained on supply that I'd felt like, we probably wouldn't see a big expansion of starts this year, even before the health crisis, but we would see improved margins and higher prices from builders because resale is also undersupplied, and I think resale has been going up just as fast as what you see here in the first quarter. But what we're hearing from builders in the last few weeks is that they have not raised prices. They are holding prices steady. So here is a look, and I've got a little more information on that. Here's weekly sales traffic per subdivision. You can see how much this has fallen off. This is actually a 4-week moving average. It is per week. And this includes, most builders are including virtual traffic here. And in fact, probably the majority of this traffic is virtual traffic. Builders early on were doing by appointment only. They're still doing by appointment only, but it's easier to manage now than it was earlier as traffic has fallen off, both virtual and certainly foot traffic. And I said I would talk about cancellations in a little bit. The blue is this year so far, the cancellation rate. But remember, a cancellation rate is measured against contracts. And so while we're seeing the cancellation rate creep up into the teens, that is largely due to a decline in the new contracts that are being written, an understandable decline given what's going on around us. So really, we're seeing cancellations hold pretty steady. If you look at the total number of cancellations, they're steady. It's only going up because it's measured against, the ratio is measured against new contracts, which is going down. So if you contrast this with what's going on in Denver, for instance, you can see Denver is having a much higher spike in cancellations. So this is further evidence that the Mid-Atlantic is weathering this storm better than most industries, and the Mid-Atlantic better than most metro areas, the most home building industries and other metro areas around the country. So this is in the midst of bad news. I'd say this is some good news. And so that's going to lead us to our final poll. Justin, if you don't mind queuing that up.
We're up. What impact has the health crisis had on your business?
How is it affecting? This is anonymous.
We're at about 70%. I'll close it there.
Okay. Yes, I would expect. I've heard about some select businesses up. I've met at association meetings, for instance, a provider of virtual tour technology. You would certainly expect that to be up as a for instance. About 1/3 of the respondents saying business is flat, and then it looks like a little over half of respondents saying business is down, either somewhat or significantly. And And I think that is evidence. I mean, imagine if this poll were given to the hotel industry or to the airline industry. I mean, it would be devastating. So, people ask how I'm doing. I try to ask how other people are doing. I hope everybody out there is doing well. I will say, we're blessed to be, this is a difficult time, but we are blessed to be in an essential industry. So, a couple of concluding thoughts here. And so I mentioned earlier the word exogenous shock, as economists would call it. There's really no precedent for this. We had a conversation yesterday with my counterparts around the country, and how informed of an outlook can we provide when we've never been through anything like this before? And I would add, we're getting close to the peak of the problem, I think, but we may not be at the peak. So this is just difficult to navigate. Trillions of dollars. The good news, trillions of dollars are being deployed to fight the crisis. Home building is holding up better than most. On the division president's call, CEO call I held last week, a couple of builders, usually, the government entities are something you complain about because they hold up the land approval process. It was really nice to hear them giving credit to the local governments for keeping the ball moving forward. Certainly things are getting delayed, inspections, certificates of occupancy, things like that. But it is moving forward. The cities and counties have figured out how to get the builder to closing. And that has been really refreshing to hear the home building industry give credit to those local governments for doing so. Tighter resale supply. So regardless, we know there's not much resale supply out there anyway. It's even less than that for people that won't let anybody into their house. So that is helping, I guess you could say, keep the light on for builders. Maybe that's even too strong. We're doing okay. We're hurting, but better than a lot of industries. And if you can't get into a resale home, you can get into home builders. This is a company. I mean, these are sales professionals. The home builders are trained to fight the health issue out there and sanitize a house after a showing. So there are some buyers out there, and while they can't go see a resale home, they can go see these professional builders that are managing in such a way to accommodate some visits. And then this has just been one of those things you just don't think about. It's just one of those things that be hard to predict, the tighter mortgage lending standards. Hopefully there will be some relief coming on that. But builders have become adept at remote showings and closings. So my takeaways, you can see the basketball analogy coming. One of the polls I thought about putting was, what professional sport are you missing the most right now? Manage your business. And in basketball, extending the game, you can be down by 6 points with 1 minute left. And, maybe you start fouling, start fouling their worst free throw shooter, calling timeouts, doing whatever you can to, even though it's less hopeful with that type of a deficit late in the game, you do your best to extend the game, buy time. And if you listened on last week, Ben with Offutt Advisors, they offered some good tips on how to manage your business right now. I would say innovate and use your team to come up with innovative ideas, and don't be ashamed to borrow, steal other people's great ideas. Years ago, I don't know, I remember the term being on the dole. And it was a disparaging term, really, about somebody who lives off the government, basically. And the stigma is gone from that. And in fact, you're really, as a company or as a business, if you're not taking advantage of the government programs, you're putting yourself at a competitive disadvantage, regardless of your attitude about government bailouts. And I think this is the last one: encourage and lead. I would say so. Before we get to the Q&A. I'm in a unique position here, and I love my job, and I love working with my clients and going to industry events and interacting with anyone in the industry. But and I've been with the company for 25 years. Yet I don't manage anybody. Strangely, I manage my clients basically, in a sense, or at least I help them. But I am senior, 25 years, and have kind of looked to for leadership. So anyway, I just started and several of y'all are doing this. A lot of you are doing it with families, we might do a happy hour or some sort of a video conference call. I started doing this with my East colleagues and team, and I've been amazed at just how much they value that. We do it every Friday now, and video conferencing is required. You can't just call in. We want to see as much as we can. And so it's really, I'd say, surprised me how valued that is. And so these are just some of my ideas. I wish I could give a little more guidance on where this is going. I've kind of said earlier, we're doing better than most industries. I think we will end up better than most. This won't be near the type of hit we took in the Great Recession, not even close. In fact, I think our industry could be one that is looked to as that has held up the best once this is all said and done. But specifically, I can say nationally, we're looking at about a 20% decline in starts this year, and would like to get a little more information before I put any sort of forecast for our local market. And I think that 20% decline is consistent with what the NHB is forecast. So, there was one more, I'm sorry. It's certainly in these times, it kind of goes along with innovate, but cast a vision and display leadership would be the last one, I would say. Either if you're not leading the company, if you're managing a team, do so there. I've seen the chat box kind of lighting up. I assume there are some questions out there, Justin. I think we've got time.
Sure. Yeah, I've got one here. It's actually from Morgan. She said, I'm part of your team. We love the happy hour Zoom.
That's right. I told you.
I've got one here on, so in New Jersey, about 3 days ago, they just identified bits and pieces of construction as non-essential. And it essentially includes, you can continue construction on projects that have already started. If it's health and safety related, if you've already begun that project, please continue. If it's affordable, please continue. But yes, any new starts have been suspended. Maryland right now, all construction is essential. What's the likelihood of something like that changing?
Well, that's, God bless Maryland MBIA and the, for those of you NVBIA members and the NAHB. Those have been effective lobbying efforts that have kept our industry essential. I loosely include myself in the home industry. And that is why they are, the organizations are pressing so hard to monitor your work sites, make sure the workers on site are observing all the health guidelines. And I had a builder contact me a couple weeks ago, and they said, I heard XYZ builder is still kind of open up business as usual. Could I verify that? And I did. And so this home builder leader called his counterpart there and encouraged him to be more cautious, because if the government, the state government found out that these guidelines weren't being followed, that they could remove home building as an essential industry. So in fact, tomorrow at 9:15 there is a webinar about job site safety hosted by NBIA. I'll have more about that in a second. And then also at 10 a.m. or at least 10 a.m. tomorrow, or at least sometime tomorrow, there is NBIA and the NHB is encouraging all home builders to do a construction stand down for 10 minutes. There are resources available at NBIA to help you do that. And so, yes, that's why they're being so diligent, NBIA, about communicating to home builders the importance of on-site health guidelines, so we can keep this as an essential industry. I think if we do that, we will remain an essential industry. To answer that question in a long way.
That's good. Assuming then, if you were to give advice to states that have already identified as non-essential, say Washington, I think Pennsylvania is non-essential as well, if memory serves, would the advice be the same? How do you come back from it?
Well, yeah. I mean, it's hard if they shut down construction. I mean, I remember in the Great Recession, we saw home builders just pivot to do anything they could to keep the lights on, whether it was remodeling or switching to a related industry, maybe other types of construction. But if all construction is shut down, then seems like you almost have to turn out the lights. That's a good question. I don't know how to respond to that. I'd have to think about that to come up with a better answer. That's a tough one. And again, that's why we're thankful that we are an essential industry. and it is tough for Pennsylvania.
Very good. Last question I've got here, unless folks are going to submit a few more. We do have about 5 more minutes till the top of the hour. Are we going to share a copy of the slides in addition to the recording?
No, a copy of the slides will not be provided unless you're a client. If you're a subscribing client and want that, feel free to email me. Happy to send it to you, but it's only for clients. The webinar being posted on the MBIA website will be your ticket to viewing all the material. Good question.
And I'll bring it home with Kristen has posted a link, marylandbuilder.org/coronajobsafety is the website address. Oh, we just got another one. Kenneth, jumbo lending did not shut down. Banks are still offering jumbo products. So there's still some activity, sounds like.
It did not shut down is correct. I think Wells Fargo, I think I saw that they are, unless it's changed, I think they are refinancing jumbo loans, but I don't believe they're originating new jumbo loans. And I think I used the word virtually shut down. I mean, it's certainly a big drop off from where it was before, but I did hear from a couple of lenders that says they do still provide jumbo loans with not unreasonable terms. So yes, that's good to clarify. Talk to your local mortgage expert if you have any questions. Not me. Okay.
So marylandbuilders.org/webinars to find the replay of Ben's webinar.
Yes. In fact, here's a couple of opportunities for you at 2 o'clock today. If you just can't get enough of webinars or of Metrostudy, Meyers Research, this is it the 4th or the 5th one? I put 4th. I'll go with that. Anyway, we've been doing these every week, so you can see where to register. Tomorrow at 9:15. The marylandbuilders.org/coronavirus, you'll see many resources, including a link to the webinars page if you want to see this again. And then if you're just tired of coronavirus, COVID-19, if you just want to talk about product, Molly Carmichael has amazing insight into the home shopper, not just the home buyer, but the home shopper. And so there's a webinar tomorrow. My screen is covering it up. What does it say, Justin? 2 o'clock. There it is. Tomorrow at 2 o'clock. What's trending in home design? So that is it. There's my contact information. If you'd like to reach out, I really appreciate your participating, and thanks to MBIA for all your great work and for hosting this webinar. Everybody have a great day.